Welcome back to the Wall Street Podcast. Today we're diving into JPMorgan's Bitcoin Mining Monthly Report. This one was released on September 2, 2025. It's a deep dive analyzing U.S.-listed Bitcoin miners' performance in August. We're looking at strategy shifts, market valuations, the whole economics picture. Our mission really is to pull out the most important insights for you from this pretty detailed report.
Absolutely. And JPMorgan, they provide a really comprehensive view here. It covers aggregate market performance, specific company news, Bitcoin price, hash rate dynamics, and a close look at miner profitability and valuations. It's all in there.
Okay, let's unpack the key findings then. The aggregate market cap for the 13 U.S.-listed miners JPMorgan tracks. Well, it hit a record. $39.1 billion in August. That's a 23% jump month over month. I mean, that really blew past the S&P 500's 3.5% gain.
Yeah, a huge difference. And a critical driver here seems to be this diversification into high-performance computing, HPC. You have TeraWulf, for example, securing a major over 360-megawatt HPC colocation deal. That's with FluidStack. And it's partially backed by Google, interestingly. Then you have Exaion also expanding its GPU fleet. We're talking about roughly 10,900 Blackwells and Hoppers, advanced chips. The strategic pivot, it's really accelerating equity value creation.
Right. So while these miner valuations were soaring, Bitcoin itself actually took a bit of a breather. The average price in August was $114,800, down just under 1% sequentially. It finished the month around $110,100. But the network hash rate, the measure of mining competition that climbed, new record highs, averaged 949 exahashes per second, up 6% month over month.
And that combination, that confluence of factors, it led to a modest erosion in mining economics. Your daily block reward revenue per exahash, basically income per unit of mining power, that declined 4% month over month, down to $55,100. Gross profit fell too, about 7% to $31,900 per exahash. And it's worth noting, these numbers are still way below pre-halving levels, like 45% and 53% lower, respectively.
Despite those headwinds, though, the relative valuations for miners jumped, record highs again. The aggregate market cap traded at 66% of the four-year block reward opportunity. That's the potential Bitcoin rewards over the next 4 years. That's a huge jump from the historical average, which was around 39% since January 2022. So it suggests a real reevaluation of these companies is happening.
Okay, so let's dig into that. If the Bitcoin price cooled off a bit and mining profitability actually eroded slightly, what's really driving this massive market cap increase for the miners? It really comes down to the market aggressively valuing that diversification. The move into high-performance computing, the report points straight at TeraWulf's big HPC deal, right? And Google partially backstopping it, taking a 14% equity stake in WilyOF. That's significant. And you see with Exaion, too, their rapid GPU fleet expansion, aiming for nearly 11,000 advanced units by end of 2025. It shows the strategic shift. Equity value creation is just outpacing Bitcoin market cap growth now. This is the 5th month in a row we've seen that trend as operators consciously move beyond pure mining.
That is a fundamental shift. So thinking about the current Bitcoin price dynamics, that slight pullback and the rising network hash rate, how does this impact the near-term outlook for miner profitability, investment sentiment?
Well, Bitcoin's price dipping slightly in August, and you had Marathon Digital's CEO Fred Thiel actually describe recent price action as frothy. That suggests some potential near-term downward pressure, maybe. At the same time, you have that record-high network hash rate intensifying competition. Put those together. It resulted directly in that 4% sequential dip in daily block reward revenue and the 7% decline in gross profit per exahash we mentioned. Now, year-to-date, BTC price appreciation is still strong, obviously, but this increased competition, the frothiness, it points to a tougher environment for pure mining revenue, which just underscores why those diversified business models are becoming so important.
Right. And the report highlights these record high relative valuations, market cap hitting 66% of that four-year block reward opportunity. What exactly does that valuation metric tell us about how investors perceive these companies now? Is it just hype or something more?
It signals a pretty significant re-rating, I'd say. Not just hype. Historically, that average was way lower, like 39%. Hitting 66% now suggests investors are increasingly looking at U.S.-listed Bitcoin miners differently. Less like speculative bets purely on Bitcoin's price and more like, well, infrastructure companies. Companies with diversified income streams. You see companies with that solid HPC exposure like TeraWulf and Exaion commanding higher valuations. Metrics like EV to hash rate, EV to energized megawatts, they show a premium. It signals the market values growth opportunities and operational efficiency that go beyond just mining Bitcoin. And thinking about the broader impact, this strategic pivot by miners towards HPC, these massive GPU investments, the colocation deals, it directly translates into more advanced computing capacity. This isn't just abstract. This infrastructure supports AI development, cloud services, complex data processing, things that are really foundational to many everyday technologies we all use. It could actually lead to more robust, maybe more efficient, potentially even more affordable digital services down the line. Think about streaming, smart assistants. It basically expands technological access.
So this deep dive paints a really compelling picture. U.S.-listed Bitcoin miners aren't just miners anymore. They're rapidly transforming. Evolving from pure crypto plays into potentially significant players in the high-performance computing and AI infrastructure space. That fundamentally changes the investment thesis, doesn't it?
It absolutely does. And maybe the provocative thought to leave you with is this. Think about how this convergence digital asset mining on one side, high performance computing on the other, how that might actually accelerate technological innovation across all sorts of industries, way beyond just the crypto market itself. What new investment opportunities or maybe market shifts might pop up as these companies keep diversifying their core functions? Something to consider.